Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Micron Technologies. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at Micron Technologies. Specifically, we talked about doing a long call spread in Micron Technologies. Now, I'm showing the long call spread inside the options playbook right now. And the concept is that the underlying stock was trading between strike A and strike B in regards to the options playbook. So the stock was trading right around this area, right about where that break even is on our profit and loss graph. So we were looking at a very short-term trade. It was all based off of what the chart was doing at that point in time. Micron Technology was more of a value play in the tech world. We see it trading at a very low PE relative to its peers. And we also see that we were looking to try to break out to an all-time high in Micron Technology. We're looking at numbers that have not been seen since the year 2000. So Micron has made a very strong move over the last 3 or 4 months, and we were kind of hoping that if we did get the breakout, we could get a little continuation on that. We're just looking for a small upside move up to around 97 on that underlying stock, and that's how we set up our long call spread. So let's see what Micron has done. I'm going to start by looking at the chart of Micron and looking at kind of what we were talking about. So right, 97.50 is the all-time high in Micron Technology. Since we put the trade on, the stock actually ran up and hit 98.27. Now it didn't hold there, but it definitely broke through the most recent high that was back in April. Now we've seen a lot of volatility, so it bumped up against that high and came all the way back down to the 65 range. And guess what? We're right back up here again. So we are seeing some volatility in underlying stock. As a matter of fact, we even considered a long straddle. And if you go to my podcast, which is Options Playbook Radio on your favorite place to listen to podcasts, I actually talked about the long straddle this week in Micron as an alternative to the trade that we're looking at today, the long call spread. And the long straddle just basically means that I want the underlying stock to move. I don't really care if it's going to go up or if it's going to go down, because I'm going to be long a put and long a call. So when you see this type of volatility, and also that Micron Technology is trading at about a 36% implied volatility, so it's not in the high end of its range right now, we thought we would consider a long straddle to go along with it. So that show is in the archives. If you go to the playlist, you can go back and see Tuesday's Stock Play of the Day, and you can get through. We looked a lot at the charts and what was going on with Micron overall. So how did we do on the trade? Well, if we look at a 5-day, and we're going to look at, in this instance, we're going to look at a 15-minute chart for 5 days. And we see, so on Tuesday's Stock Play of the Day, that was the 11th. We always tape live at noon. So basically, since we talked about Micron, the stock, well, I guess it flatlined for the rest of the day. So this was the end of the day on Tuesday, opened up, kind of came back down where we were at, but it looks like it's really bouncing right along this 20-day moving average, had another big spike up. This is when we set a new all-time high, going all the way back to the year 2000, 98.13. Didn't stay there for long, though. We came back down again. And right here, this has to be a little bit concerning that we had what we've talked about this before. This is actually considered a death cross, but it's not as pertinent when I'm looking at a 20-day moving average, just moving through a 50-day moving average. It's much more, I think it has a lot more weight to it if you're talking about going through a 200-day moving average in general. But this isn't a good sign because you had a lot of momentum taking it up to the new high. Now, one of the big things about a chart overall is every time you bump up against resistance, it's harder for the stock to resist. So 2, 3, 4 times before you know it, usually the stock will break out. And when it breaks out harder than it normally does when it just breaks through the first chance, the first opportunity that it gets to break to all new high. So keep that in mind. But bottom line is we were just looking for the stock to get to 97. So that was fairly quick. The stock, when we looked at it on the show, was 93.79. We hit 98. We should have had an order in to basically sell our long call spread fairly close to the maximum. I would have definitely, it was a 5-point wide spread. So I would have had an order in to try to sell around 450, maybe 440, right in that range. It's really hard to get that last 50 cents out of a spread when you have that position on and you have some time value in it. So I don't know if you would have got out of that trade because it happened pretty quickly. You'd have to be paying attention to the markets in order to get out of that trade overall. But what do we do from here? Let's go in and look at the actual bull call spread. We should be up on that position. So let me go to the Ally Invest option chains. And here we have last trade. It's up 77 cents on the day, 96.38. We went out to the very short term expiration. I don't know why that just happened. Okay, I clicked on the wrong tab. So we went to the shortest, a very short term expiration. And we talked about how important on Tuesday's show that expiration is when you are doing a long spread, because you are buying one option that wants the market to go up and you're selling one option that wants the market to go down. So if you're correct on your forecast, that short option contract works against you. So you want some time decay. And where do you get the most time decay? On the shorter term option contracts. So in this instance, the stock, when we put on the trade, just looking over here at my screenshot, it was at 93.79, almost 94, just short of 94. We see it now at 96.33. We bought the 92 strike. We sold the 97 strike. So we were hoping that the stock would at least go beyond 97. And when we looked at that trade, we put it on for a net debit to the account of around $2.25. That is if you filled at the midpoint. And right now we see it at $3.26. So the stock is doing well. What I would do to close out the trade, or if I had this position on, if I didn't get out when it hit 98, which you do want to get out because it's got an expiration date. It's only has right now 7 days remaining to live. So I want, whenever I see that opportunity to get out at close to the maximum of the trade, I'm definitely want to do it. So here's how I would enter a trade. I would have this trade in my account ready to close the position. We were buying to open the 92 strike. So we just click this little drop down and we hit sell to close. So we're selling to close the one that we bought. And then we sold to open the 97 strike. So we're buying to close the one that we sold. Right now, we see a net credit of $3.33 at the midpoint, if we could fill at that price. And I would say I'd be okay getting $4 on this trade. We paid 2.25. You can try for a little bit more, but I would put this order in and I would make it a good until canceled order, or basically good until the option contracts expire. And I would let this trade work. Now, as always, it's not meant to be a recommendation. These are just paper trades overall. But if I ever have a long spread in and I put that position on, especially a shorter term one, I always want to have a good till canceled sell order, just in case something like what happened this week, where the stock ran up to 98 and ran right back down in that instance, because I want to grab that opportunity to get out of that trade as quick as possible here. So you could go $4 if you wanted to. I maybe $4.30. That's not too bad, but realize I don't necessarily want to put in 5, because 5 is really hard to get. You're going to have to be very close to expiration, and it's going to have to be above. It's going to have to be above 97. It's going to be 98 or ish or so to get close to $5 when you're closing out your spread. Because if you think about it, the width of the spread is 5 points. So if you receive $5, that means that the market maker is getting nothing for that trade, right? Because they're making that market. But if you sell this and get $5 for that trade, that means that they're selling it at cost if it's in the money, obviously. Now, you still have risks to the downside, so you want to keep an eye on that. And we talked about if the stock gets down to 92, Well, at that point in time, I would consider just getting out of the trade, and mainly because then my long option is an at the money option contract, and that's where the most premium is. So if by the end of the day, for some reason, Micron technology went down to 92, I would consider just closing out that trade overall and not taking the risk over the weekend. But we also discussed on Tuesday's show that we managed our risk by doing the spread. We paid 2.25 for it if we filled at the midpoint, and we have $2.75 worth of upside. So in that instance, on the downside, I can just let that run as long as I didn't over leverage my account and buy a plethora of long spreads and use all my capital, right? So in that instance, if I'm very leveraged on it, well, yeah, then I want to manage my risk. But if I'm doing it as it was intended, we build this as a FOMO trade as opposed to buying the stock outright. Let's look at a long call spread just in case we get that breakout and we could get some profitability, and then consider after the fact maybe just buying 100 shares of Micron as it is setting a new high and hopefully building some momentum in the marketplace overall. All right, so I'm going to look at one quick thing. We'll run down and I'll talk a little bit once again in the profit and loss graph here at Ally. And let me zoom in a little. Okay, so here's what we got. The market is up. Now this is live, so this isn't based off of our cost basis that we would have put on Tuesday. But I just want to show you that we still have a lot of time to get. There's only 6 days. Well, on this chart, there's only 6 days remaining, 7 days total overall. So if we look at this, what we really want is this green line or this colored line right now that shows you the profit and loss graph as of today. We want that to start morphing into the dotted line, which is at expiration. So that's where we end up getting our maximum on that trade. So if we were at expiration right now, we're up about $1 on the trade, which if you paid 2.25, you're up $1. That is not too bad. But if at expiration that stock did go up, we would be up almost $2 on the trade overall on that expiration date. This is where we would be crossing that dotted line, and the gray line is where the underlying stock is at. So if I go and I move this, let's go all the way down and go to 0 days to expiration. That will be 1 day remaining. Put my cursor right in this area, talking about that underlying stock getting up to about the $96 range. If it stays right at that range, we're going to have underlying price there. At the expiration date, you're talking about a $75. I'm just trying to keep my cursor right there. It says $75.50 at expiration. That would be up on that trade, but at 96 exactly. Okay, that would make sense because we'd be at 96. If we go up to 97, we'd be up to 175.50 on that. Oh, I'm sorry. This is as of today if we paid for the trade. That's what's confusing me. So I apologize for that. Here's my takeaway. If we look at this trade, and we did this trade, all you want to know is that if you are correct on your forecast, you want this curve, this as of today line to start morphing towards that dotted line. The only way that happens is if this time premium starts to erode in the option contract that we sold. If you are incorrect on your forecast, the underlying market comes down here, you see that our 92 strike call has a lot of premium in it. That is helping us. So if we are incorrect, I want to be incorrect on my forecast sooner than later so that I can capture some of that time premium if it came down to the 92 strike. And then eventually, as it keeps going down, that hurts us more and more because time premium starts coming out of our option contract in general. All right, that's going to be it for this episode of the stock play of the day. Now, we'll be back on Tuesday for the next stock play of the day. Please click subscribe, ring the bell, and you'll get all the alerts for all the stock plays of the day. Thanks for coming by.